Hello and welcome back. In this video, we are going to look at tax bracket and tax rate. Sometimes when people come to my office, they will ask me things like, what is my tax bracket? Or what is my tax rate? And I think they believe the two are the same. I think that some people believe that their tax bracket or tax rate means that their total income is what is being taxed. They think if they had $25,000 of income and tax at 20%, they would have to pay $5,000 in taxes. 25,000 times 20% equals 5,000. The terms tax bracket and tax rate are related, but refer to different aspects of the tax system. Let me break this down for you. Let's start with a tax bracket. A tax bracket refers to the range of income that is subjected to a specific tax rate under a progressive tax system. The system we use in Canada is called a progressive tax system. In a progressive tax system, income is divided into brackets. It's like cutting your income up into pieces, and each piece or bracket is taxed at a different rate. As your income increases after a certain point, each piece falls into a higher tax bracket, which is taxed at higher rates. The tax bracket you fall into depends on your taxable income after deductions and exemptions. Let me do a small example to show you what I mean. Let's say we had a simplified tax system with the following brackets and rates. Let's say the government would tax you a rate of 0% on income from $0 to $10,000. A rate of 10% on income from $10,001 to $20,000. A rate of 20% on income from $20,001 to $30,000. Now, let's say you did your taxes for the year, and your total income was $26,000, and after you subtract your deductions, your taxable income was $25,000. What will be your tax bracket? Let's see from our simple tax system what that will be. Your $25,000 of taxable income is the information we will need to calculate your tax brackets. In this tax system, the first tax bracket is $0 to $10,000. The second tax bracket is $10,001 to $20,000. And the third tax bracket is $20,001 to $30,000. If your taxable income is $25,000, and we were to break this down according to this tax system, 10,000 plus 10,000 plus 5,000 is equal to 25,000. It means then with income of $25,000, your tax bracket would fall within the third tax bracket. Let's look now at tax rates. A tax rate is the percentage at which income is taxed within a particular tax bracket. Each tax bracket has a corresponding tax rate. There are generally two types of tax rates to consider when talking about tax rate: marginal tax rate and average tax rate. Marginal tax rate, the rate at which the last dollar of your income would be taxed. This is the rate applied to the highest portion of your income that falls within a particular tax bracket. If we looked at the example we just did, we said that the tax rates were 0%, 10%, and 20% respectively, which means that 20% was the rate on your last dollar of income. So, if we want to know what your total tax liability would be, we will need to calculate each bracket by its percent. The first tax bracket is $0 to $10,000, so I multiply $10,000 by a rate of 0%, which equals $0, which means you would have paid no taxes if your income was only $10,000. The second tax bracket is $10,001 to $20,000, which equals another $10,000, so I multiply $10,000 by a rate of 10%, which equals $1,000. Which means you would have paid $1,000 in taxes if your income was $20,000. And the third tax bracket is $20,001 to $30,000. I only have $5,000 left out of the $25,000 that falls between $20,001 to $30,000. So I multiply $5,000 by a rate of 20%, which equals $1,000, which means you would have paid another $1,000 in taxes on the $5,000 over $20,000. So now, I add all the tax brackets to see what the total will be. $0 plus $1,000 plus $1,000 equals $2,000. Which means, if you had a taxable income of $25,000 using this tax system, you'll be liable for a tax of $2,000 and not $5,000. Let's look now at what average tax rate is. Average tax rate, the overall average rate at which your income is taxed. This is calculated by taking your total tax liability minus any eligible refundable credits divided by your total income. The average tax rate takes into account all the different rates applied to different portions of your income across multiple tax brackets. If we look at the example we just did, it will mean that the average tax rate would be $2,000 divided by your total income of $26,000, which equals 7.7%. So, to summarize, a tax bracket is the range of income subject to a specific tax rate. A marginal tax rate is the percentage at which income within a tax bracket is taxed. An average tax rate is the overall average rate at which your income is taxed and is calculated by dividing your total tax liability by your total income. Keep in mind, not all income is taxed the same. For example, capital gain, eligible and ineligible dividends, these types of incomes are taxed differently from employment income. Understanding the distinction between tax bracket and tax rate will help you in planning and managing your finances more efficiently, especially in a progressive tax system where different portions of your income are taxed at different rates. Let's move on to the next video.